from Lincoln Financial's Client Investment Strategies team, and I'm thrilled to welcome back our Chief Investment Officer, Jason Bronchetti. Welcome, Jason.
Hey, great to be back, Matt. Regardless of the market backdrop, I always look forward to these conversations.
Me too. And like last quarter, Jason and I are going to cover some of the top questions on the mind of investors. And as always, our goal is to provide you with clear, actionable insights that you can bring directly to your clients. So with that in mind, we'll share resources along the way from our client-approved Market Intel Exchange Chartbook, or MIE, which the team calls it here at Lincoln. You can access that right here within the webinar by clicking on the resources link. All right, Jason, ready to get started?
Let's do it.
All right, well, we've got a lot to cover, and I know right now the financial professionals viewing this are being hit with questions left and right, given the recent market volatility and all of the tariff news. We'll get into the latter part of that shortly, but for now, I wanted to start where we ended our conversation in January, because what we discussed then is even more relevant today. So as a parting message, I had put you on the spot a bit, and I asked you to share your single favorite slide from MIE for 2025. Guys, can we get that slide up here just as a reminder? Perfect, perfect. So at that time, let's remember, put yourself in the frame of mind. Investors were borderline euphoric coming off back-to-back 20% gains for stocks. But you chose for your closing message to share this slide right here, right? Slide about market drawdowns and about long-term market resiliency. And then you went on to mention that you did expect a double-digit potential, at least a potential double-digit drawdown in 2025. Now, unfortunately, that proved to be unbelievably timely. But can you just tell us a little bit what you were seeing at the time that made you choose to share this particular message amid so much optimism at the time?
Yeah, well, look, I definitely didn't expect that we'd see markets correct this quickly. But my aim there wasn't to predict any kind of specific event. I was cautiously optimistic at the time as well. But given how calm markets have been, I just thought it was a good time to be proactive and arm financial professionals with a resource to help clients navigate the inevitable turbulence that we likely see. I mean, historically, 10% corrections are common. They happen about every other year, and we hadn't seen one in 2024, so it felt like a pretty safe bet that the odds were favoring one in 2025. So, I mean, look, I'm by no means trying to imply the events that are causing the volatility at the moment are in any way normal. I mean, I think they're far from normal, but volatility itself is in fact normal and should be expected. So it's the price that we pay for the opportunity to participate in the long-term growth of the markets, and that they've provided historically. So I know that price feels high at the moment, but calm, patient investors are usually rewarded in the long run.
Yeah, I always remember the quote. It's the market is a device that transfers money from the inpatient to the patient. I think that really applies right today.
Absolutely.
And to the financial professionals watching as well, it's not too late to use this resource to help put things in perspective for clients. You can find it on page 23 of the Market Intel Exchange. All right, let's stick on the topic of market volatility. Because we know in times like this, financial professionals, they are always looking for resources to help navigate these type of conversations. So this quarter, what we did in MIE is we rolled out a brand new dedicated market volatility section. And the idea here was to centralize and bring together some of our most popular client visuals all in one spot for easy access. So I recommend to folks to check that out, the folks that are viewing this. There's lots of great content in there, One chart in particular, though, I think is especially timely given the recent rise in the VIX. And I think this one is also somewhat unique, right? Because it puts a little bit of a different spin on volatility, where we're looking to frame it somewhat as a friend rather than as a foe. So guys, can we get that chart up as well, please? Perfect. Okay, Jason, you're familiar with this one. So tell us, what's the story here?
Yeah, I mean, so a little background on this. I think most investors instinctually understand volatility because, look, you can feel it, and the uncertainty and the emotional swings. Like you can feel that. Now, the VIX, I think, helps quantify that fear by using options prices to measure expected near-term volatility. It's pretty frequently called the fear gauge because it reflects investor sentiment in real time through the options markets. But this is where psychology and the numbers kind of intersect a little. And when fear is spiking and portfolios are being hit like they are now, psychologically, it can be tough to hang in there. I mean, it just feels like the absolute worst time to be invested.
It really does. I mean, even as someone who knows the data, I know the data well, I'm feeling that exact emotion right now. I can't help myself.
Yeah,
I look at my
too.
accounts every single day, and it's killing me here.
Yeah. I mean, speaking of psychology, it's probably better just not to look. But what's interesting is the historical data shows us these high fear moments are often the time when we should do the opposite of what our emotions are telling us to do. So what the team did here is map out and bucket all of the daily closing VIX prices since 1990 into several ranges that you can see there, across the bottom. And the pattern is pretty clear. Higher fear levels historically correlate with stronger returns over the next 12 months. So as an example, when the VIX closes between 35 and 45, which is where we've seen the last several days, if not even higher, the return on the S&P over the next year was nearly 26%.
Yeah, I mean, you said it. We've actually touched that 45 to 55 range there, which puts you into an even higher band, at least historically, with an average one-year return of just short of 33% there.
Yeah, and look, I want to be clear. This isn't at all advocating for market timing, because if you look, all the way to the left, you can see how this investment in the S&P made on any day, regardless of where the VIX closed, and those entry points on average still generated nearly a 10% return.
So that's like your DCA investor, right?
Yep. Exactly. Yeah, I mean, I think the takeaway here is, historically, it's always been, good to invest if you have the right time horizon. But if you're fortunate enough to be able to invest more when fear is high, the data shows that patient investors are rewarded more often than not. And it's not easy. And this time could always be different, especially given the enormous amount of uncertainty surrounding global trade at the moment. But this is solid proof, I think, a good proof point for financial professionals that you can kind of lean in, help frame volatility as an opportunity rather than a risk.
Yeah, and I always think the most successful conversations about volatility, you always start with empathy before you get to the data, right? Because these are real feelings that people have. I just said I have them, right?
Yeah.
So the reality is, sometimes we want to just say, take a look at this chart, it goes up and to the right. Sometimes that's just not enough reassurance on its own when emotions are heightened.
Absolutely.
But at the end of the day, I mean, I think you'd agree, the message we all want to get across, everyone in this industry, is stick to your long-term plan and diversify. And really what we've shared so far in these two slides are just two of the many tools in MIE that can help give clients the facts to anchor them to, rather than the feelings there. So I do want to dig into your comment about uncertainty surrounding global trade. I mean, you opened that Pandora's box here, so let's get into it, because I think that's a great segue into talking about what's driving the market volatility this year. I think most agree that global trade, namely surrounding tariffs and trade wars, are the culprit. I think we agree on that. But before we get into that specifics, we'll talk about that a bit more here. But I want to mention two things, because first off, I think it's important just to preface this with by saying this. In 2025, markets and politics have become completely intertwined. There's just no way to talk about one without talking about the other. But that doesn't mean we have to be political, and we absolutely will not. So that's number one. Good. Number two, we've added several slides to MIE to help financial professionals have balanced conversations about tariffs with their clients. So make sure you check those out in the economy section.
Yeah, it's good stuff.
Yeah. Okay, with that said, can you talk a little bit about how we got to where we are today so quickly after hitting an all-time high? Seems like a long time ago. It was February 19th.
Yeah, it feels like a lifetime ago. So, I mean, I think it's fair to say that trade policy and all the uncertainties surrounding the rollout of tariffs is clearly the catalyst here. But I just want to acknowledge first that this is a dynamic situation that's changing by the minute. There's bound to be more negotiations and news about potential negotiations, and they'll probably move both markets and sentiment in the short term. But uncertainty will remain. So we're going to focus, I think, this conversation on the potential impact of the proposed tariffs. So, let's contextualize a little on the recent volatility, though. So I think post-election, there was an outpouring of excitement in the markets. Folks thought that we had certainty on the direction, and the assumption was we could see a pro-growth, low-regulation agenda. And because the impact of policies like tax cuts and deregulation are relatively easy to kind of model out, investors bid up equities to price in those positive expectations. At the time, tariff details were unknown, and I think most frankly underestimated the likelihood that they would actually be pursued with such fervor. So they were largely ignored by traders. But since mid-February, as you mentioned there, markets have started to discount some of the downside risks, and it's been especially amplified since last week when we learned just how serious the administration is about using tariffs to reshape the way global trade functions.
Yeah, they certainly seem pretty serious about it. And I think, interestingly, survey data started to plummet well in advance of the equity market. So it seems like Americans kind of saw it coming to some degree. But one thing I keep coming back to is that in large part, isn't the administration kind of doing exactly what they said they'd do on the campaign trail? I mean, should it be so much of a surprise that it causes markets so suddenly to rush to price in these recessionary outcomes?
Yeah, I think what it really comes down to is the sequencing of policy, along with the pace and the degree to which policy is being implemented right now. It feels like everything everywhere all at once. And yeah, we've always known there are parts of the agenda that are pro-growth and parts that maybe aren't. And despite, I think, the positive reaction after the election, the question was always, which agenda items would the administration prioritize? Which would they prioritize first? And I think the real important part is that last week really caught everyone by surprise. Yeah, we expected tariffs, but what was expected to be a targeted negotiation tactic and a surgical approach to advance U.S. commercial interest was much different in terms of what was laid out last week. Both the approach and the magnitude were well beyond what investors anticipated, and it clearly spooked the markets. The administration sent a clear signal. Minor adjustments aren't the goal here. For better or worse, this is an attempt to reshape the entire global world order. And markets are now grappling with the potential reversal of decades of globalization that's been largely positive for American consumers. And so the reversal of which, regardless of your politics, would cause significant disruption in economic activity.
Agreed. But I've heard some speculate that the announcement could end up being somewhat of a de facto clearing event. So bear with me. So yes, the tariffs, they're much higher than expected, much worse than expected, but at least now we have direction, right? We can plug them into the models, as you mentioned. We can estimate their impact. I know the output won't be pretty. It's not going to look good. But do you buy at all that this can lift some of the cloud of uncertainty and allow businesses to, I guess for lack of better terms, just adjust and move forward from there?
Yeah, I think you'll definitely see lots of attempts to model this out, but I'm not so sure we have a level of certainty as to what this will look like in 5 days, let alone 5 months from now.
Minutes,
yeah, exactly. So here's how I think I'd frame the situation. I guess all totaled, the U.S. effective tariff rate has the potential to be, let's say, around 22%, and that started the year at 3%.
Wow.
Right? So we haven't seen levels like this in 100 years. It's completely unprecedented in the context of the modern global economy. There's really nothing to compare it to. And it's also hard to gauge the ultimate implications of retaliatory measures from all of our global trading partners. So there's going to be a lot of attempts made to model out the first order impacts of tariffs, but there's really no way to model out a complete rewiring of global supply chains and trade flows, other than just to recognize, at least in the short run, that it would be likely to increase prices and represent a significant impediment to global growth.
I think what you're describing there is stagflation, if left unchecked, right? So lower growth, higher prices, not a good outcome. That's about as bad as you can imagine, at least historically. I know from our conversations, though, you're not overtly negative, right? What's your level of optimism on negotiations and the ability to avoid that type of outcome?
Well, look, I'm still optimistic in the long run. I always try to view things through a lens of kind of long-term optimism, but economic realism.
I like that. I haven't heard that.
So I think there's plenty of debate about what the long-term impact of tariffs are going to be, but the one thing that most can agree on is the pain they can cause in the short term. So over time, though, I wouldn't bet against America or the long-term potential of equity markets, really no matter how bad it feels at the moment. But the economic reality is that tariffs and trade wars are a point of serious friction. And look, if they persist at these high levels, they'll have a negative impact on growth for a meaningful period of time, which I think, of course, raises the odds of a recession. That being said, we've seen some signs of negotiating activity already, and we can certainly hope more trading partners rush to negotiate, but it may take some time. And I think at this point, we're still in discovery mode on what exactly the concessions we need from trading partners, what they are to really delay or to lower tariffs. But I do expect we'll continue to see some of this negotiated down, and the final level of tariffs may not be as high as what was announced last week. But the chances are certainly greater than zero that the president is serious about this. And even after negotiations, tariff levels will still be meaningfully higher than anticipated just a few months ago. I mean, Scott Bessent has really doubled down, referring to this as the pursuit of grand global economic reordering. It's hard to envision the pursuit of that kind of a goal not driving significant volatility in the markets. So for now, I expect we'll see bouts of volatility. There could absolutely be more room to go to fully price in a weaker U.S. growth outlook. But in the long run, we'll get through this. We've recovered from 100% of the drawdowns in history, and I don't expect this time is going to be any different.
100% is about as good as you can get, right?
Yeah.
I think patience is the theme of the day.
Yep.
Bloomberg actually did a survey. I don't know if you saw this. More than 70 economists immediately after last week's announcement.
I don't think I saw it.
So I mentioned it because the results were largely aligned with that view.
Okay.
So 92% agree that the announced tariffs risk an economic downturn and increase in inflation.
Okay.
But 58%, so same people, said they believe the tariffs will lead to negotiations that'll significantly reduce or even maybe eliminate some of them.
Yeah.
So to your point, though, on the short-term pain, you mentioned Secretary Bessent. I'll mention Secretary Bessent as well. He all but acknowledged the pain in an interview right after the tariff announcement.
Yeah.
You probably saw this. He was asked if tariffs would cause prices to go up, point blank. And I'm paraphrasing a little bit, but he said, they could, but they don't have to. Businesses don't have to pass them on. So even for me, those were some pretty easy dots to connect, right? So you got two outcomes there. And either of them causes short-term pain. They pass the prices on. Consumers see higher prices, of course. If they don't, or at least don't in full, say, we're looking at a reduction in corporate profits. And this, of course, not only hurts stock prices, and you see some of that being priced in now, but the second-order effect could also lead to job loss as companies try to hold on to their margins. Do you think I'm reading that the right way?
Yeah, I think you are. I mean, I think it is. It's kind of negative either way. I will say that I think the notion that tariffs wouldn't get passed on to the consumer, kind of defies some economic reality or some fundamental principles of commerce. But that being said, I think while tariffs are obviously the main story, fortunately they aren't the whole story. There are many other factors at play in the global economy beyond the current administration, and we also know that the administration has expressed a multi-part agenda. It's seeking to spark private business activity, hiring through deregulation and tax cuts. And it's an ambitious plan, and a lot needs to go right for it to work. But over the long term, success or failure, I think, is ultimately going to depend on how these policies interact with each other. And there is at least a potential scenario where tariffs are negotiated down and the administration delivers on pro-growth tax cuts and regulatory part of the agenda, all those types of things. I mean, and that would send both sentiment and markets higher, depending on the degree of erosion that I think could be experienced in the meantime.
Yeah, or maybe it could all turn on a 7 a.m. tweet on a Thursday. Who knows?
Who
right?
knows?
I mean,
Who knows?
I like that outcome you put there. I hope that's the case. But we saw how sharply markets bounced around throughout the day yesterday based on nothing but speculation.
Tweets or fake
exactly,
tweets.
But markets are just begging. I think that proved at least that they're begging for a whiff of any positive developments on this front. So wouldn't be surprised in the short run if we also see some of these temporary relief rallies that could be based entirely on a tweet. Like you said, it's really the follow-through that'll matter at the end of the day. Question, what about the Fed? Do you think the Fed puts alive? Are they going to step in? Are they going to rescue markets, come to the rescue again? Yeah.
Look, I think the bar is a lot higher for the Fed to cut at the moment, given the upside risk to inflation right now. And Jay Powell was pretty adamant about that point, I think, when he spoke on Friday. We're obviously right in the midst of this elevated anxiety over tariffs and market volatility, but the economy as a whole is still in a solid place, at least for now. And I know the data is backward looking, but coming in pretty good shape. So I think they're going to be patient and see how this trade war shakes out as it relates to the impact on both inflation and employment. So despite the president calling on them to lower rates last week, and this Fed has a pretty good track record of maintaining their independence, and also though navigating through challenging times.
Battle-tested.
Yeah, exactly. And look, fortunately they've got the ammunition to help the economy when they need to, but they're definitely in a tough spot and probably not going to be kind of quick to act.
So on the president, what about a Trump put? Is it non-existent in Trump 2.0? I mean, we know it was existent in Trump 1.0. I know they're saying it's not existent here, but do you expect there's a level where he just kind of throws his hands up and says enough, right, and steps in to support markets?
Yeah, I mean, I certainly don't have as high a conviction on this as I did a week ago, but I still think that may exist. I mean, it's clear. One thing's I think very clear though, that like the strike price is much lower than I think what anyone had previously expected. I expect that the administration feels that they have some cover for markets to endure pain kind of early in the term. Even still, my guess is that the administration may have underestimated just how negative the economic pressures and market reaction were going to be to their approach to tariffs. So if this weakness were to continue, I wouldn't be surprised to see some degree of further capitulation as the pressure to figure out a solution before midterm election season is just going to continue to intensify.
And number one job is to get reelected, right?
Yeah.
If I were to look for one positive development to call out, and what's been pretty tough beginning into the year, there's not many to speak of. It's that diversification, at least to this point, is finally showing its value, right? Bonds, value, international, they've all held up a bit better than the S&P, and I think most importantly, right, it's helping to as best they can. It's helping to soften the blow for balanced portfolios and folks who have been committed to being diversified, right?
Yeah, I mean, look, we talked about diversification a lot during the last quarterly discussion, and it's only been 3 months, and all equity markets are now, repricing considerably lower in the face of what is real economic uncertainty. But so far, this is shaping up to be one of those years where investors may be thankful that they're diversified, especially those that own bonds. At least to this point, they're largely back to providing portfolio protection from falling equity prices, which is a positive sign for diversified investors.
Yeah, I couldn't agree more at that point, because being able to just quite literally point out the benefits of diversification, especially during times like this, I think that really can help reinforce good client behavior, and we haven't had that for quite a while here.
Yeah, that makes sense.
So, Jason, I believe we've got just a few minutes left here. We've shared a lot already, but I wanted to share one more slide from MIE, really in the spirit of helping with these ongoing client conversations about market volatility. So yesterday, equities, we know, bounced around quite a bit throughout the day, but we did touch bear market levels in the S&P. So I'm going to pull this out of the archives, down 20% from the recent high. Can we get that up here, guys? Perfect. They're on the ball. This chart was unbelievably popular with financial professionals during the 2022 drawdown. It's one of our greatest hits by far, but I never imagined we'd be resurrecting it in April of 2025 this quickly. I do think, though, that this can add and provide quite a lot of value right now, regardless of where we ultimately land in the days and month ahead. So what you're looking at here are all of the bear markets since 1946. And then across the top, you see the total peak to trough drawdown of each of them, the total length of each of them, and then the date that the index officially crossed that 20% down threshold. This part's really important, though. The returns 1, 3, and 5 years later are all measured from the date the index was 20% down, not from the bear market bottom. So this isn't like you're buying at the bottom. That's easy. That's an easy analysis to do, right? So across the bottom as well, you see the averages. So you can see that 1 year later, the average return from when the 20% downside was triggered was about 17%. And then 3 and 5 years later, and these are, of course, all cumulative, results were positive in all but one occurrence, with average gains of 37% and 65%, respectively.
Yeah, and look, I think the closest comparison to how quickly we fell here that's memorable for most is 2020 during COVID. I mean, the market peaked on February 19th, the exact same day as this year.
How about that symmetry?
And we hit a bear market quickly, only to recover and return 125% over the next 5 years. So, look, I'm not suggesting by any means that happens here again, because I think the circumstances and the fiscal response will be very different. But these are great numbers, and I think they help to frame out the opportunity for long-term investors.
Absolutely, couldn't have said it better myself, Jason.
I don't know about that, but thanks for having me. It's good to be with you.
Absolutely. And one note on that last slide: because a week ago when we published MIE, we did not anticipate this being a story yet. You're not going to find it in the main document linked here in the webinar, but it is available for use, and you can get it by reaching out to your link in contact. So with that, thank you for joining, Jason.
Thank you.
Appreciate it, and thank you for everyone who tuned in as well. We look forward to seeing you next quarter with what we hope is a much, much calmer update. Thanks.